Good morning once again. It's good to be back. And I have my esteemed panelists here, where today we'll be discussing financing the gold value chain. Obviously, to my left, I have Tamsin Fremantle. Welcome, Madam. I have John. Welcome, John, all the way from Australia as well. So I'll try set the tone. I always feel like we want to contextualize what we're talking about. So the synopsis is that Africa remains a dominant global gold producer, yet its capital markets capture only 1% of global equity activity. The Africa Capital Markets Report for 2025 highlights a systemic reliance on bank financing and sovereign debt, which leaves the capital-intensive gold value chain underfunded by domestic markets. To transform this, Africa must pivot towards a market-based financing by strengthening corporate governance, integrating regional exchanges, and unlocking the vast assets held by domestic pension funds. As I transition to ask the questions, I think we definitely know that there is a financing challenge, and to address this, I'll go to my panelists, and I want you to set the tone and also share, I think more than anything, your thoughts when it comes to financing of the gold value chain or the gold ecosystem itself. So I'll start off with Tasman. Can cross-producer linkages of African gold producers such as South Africa, Ghana, Mali, Zimbabwe, Chad, DRC tap into interconnecting their national and regional exchanges and working with multilaterals such as Afreximbank, Development Bank of Southern Africa, AFC, to foster pooled financing or funding and diversified investor pools for shared or syndicated infrastructure such as refineries? It's a loaded question. I obviously expect you to, I'll give you 10 minutes. I think just unpack it, because I'm pretty sure you want to, unpack it in ways where you also do justice to the question. So I'll give you 10 minutes. Thank you.
Thank you very much. I actually run a course on capital markets development that goes over 3 days, so 10 minutes is quite short. Okay, so to your question, the simple answer is yes, and the complicated answer is no. We have around 39 standalone exchanges on the continent. There are only a handful that actually have any depth in terms of capital availability. That has to do with local market development. We heard in the first panel about the importance of regulation. I am absolutely on board with that. Markets don't grow unless they're regulated. But what many of our markets do is they default to over-regulation, which stifles markets. So we have the opportunity to have foreign investors in our markets. Foreign investors are great. They supplement what is available domestically. They also help us spread the risk. But foreign investors, or in fact investors that are from outside of the country, even if they're African investors, other African investors, want to play in markets where they understand that there are rules and the rules will be enforced. So that's the backstory. Okay. So that's part of what we need to get right. But can we do it by creating regional exchanges? That is the loaded part of the question. There's a lot to do with sovereignty in that question. We have two regional exchanges on the continent. The older one is the BRVM, based out of Abidjan. That I would say has worked because it's only ever been the exchange in that region, and it serves the West African Economic and Monetary Union. So it's not as if they took 8 or 9 exchanges and tried to get them to work together. So that exchange as a regional exchange really works. BVMAC, based out of Douala in Cameroon, is the same. It's the only exchange that has ever been in that region. So let's look at it slightly differently. What about the cross-linkages that you spoke at? What about getting the gold producers on board to actually build shared infrastructure? The question was very specifically around refineries, but we know that the infrastructure involves your transportation as well as your refineries. There's a whole lot that goes into it that can be shared. So a country, for instance, like Burkina Faso or like Chad or like Mali, which is very up and coming at the moment in the gold space, they may need to share infrastructure with a neighbor who has more developed infrastructure. So how do we build that? And that, I think, is the interesting question. Not how do we actually get our exchanges to collaborate or work regionally together? How do we issue instruments across exchange that can be mirrored? And that, I believe, is entirely possible. So that would be something where, again, we spoke about it earlier, having a gold-backed instrument. So it needs to be FX agnostic. That's one of the biggest problems that we have on the continent, is our exposure to hard currency and what it does to us in the local space. So FX agnostic, and then I'm just going to throw it right out there. The Nordics have done it on infrastructure already. We need to do it in a tokenized fashion. That's what our young up-and-coming people understand. The median age on the continent is 19. Okay, 70% are youth. So we need to be catering to future investors as well as current investors. I'm not going to take 10 minutes. I'm going to leave it there. I think we can have further discussions.
Thank you very much. Well summed up. And thank you for giving me back at least 5 minutes. Over to you, John. What could be the fastest but logical way to grow local exploration financing for the gold value chain within African gold producers, and subsequently start growing African juniors for the African gold value chain? Over to you, John.
Okay, good morning, everyone. I'll answer that with a bit of a framework first. My home now is Nigeria, and so I'm going to speak specifically about Nigeria, but a lot of what I talk about is transferable across the continent. In Nigeria, we don't have a mining industry as the rest of the world understand it. It's primarily an artisanal one, and the artisans will always be there. There's not an industry or a sector that needs to be replaced or will ever be replaced. But what we need to complement it is a world-class mining system, and that can only happen if there's exploration. And exploration only ever happens if there is risk capital available to do the exploring. And so the sticking point is, where does that risk capital come from? And across most of the continent, that has come from foreign juniors, typically listed on ASX or TSX or AIM. In Nigeria, we have had very little of that. But what we do have is we're actually a wealthy nation. And we have functioning institutions like the stock exchange, like SEC, our stockbrokers, et cetera, So the solution that we are putting into place right now is simply replicating the ASX TSX model in Nigeria, drawing upon retail investors for this risk capital for the juniors. That will then ultimately lead to the development of mines.
Thank you, John. Well summed up. Framework, structure, and it will be interesting to see what actually comes out of Nigeria. Franklin, it's good to have you. Thank you very much. Franklin, to you, is the AFC, is it possible to create and leverage cross-border partnership pivoting on African gold producers engaged with the AFCFTA to crowd in capital for structures beyond standard loans, to focus on infrastructure across the full gold value chain and unlock value chains that target African-led industrialization?
Good morning. Thank you. And firstly, my apologies for being late. My name is Franklin Edochie, Deputy Director and Head of Metals and Mining at Africa Finance Corporation. which is a multilateral institution headquartered in Lagos. We cover 5 key sectors, my sector being the metals and mining, ended last year with a $20 billion balance sheet. We funded the Segulola Gold Project in Nigeria. We are funding the Bauma Gold Project in Sierra Leone, had done Bonikro in Cote d'Ivoire, so we're quite entrenched in the gold producer space. Also looking at various projects in South Africa, Zimbabwe, Ghana, which we're looking to expand throughout this year. I think for us, one thing that we've observed across over the last 12, 24 months, which is sort of coincidental with the boom in gold prices, the gold producing jurisdictions in West Africa, they're all looking to build refineries in one way or the other, whether it's the private sector or the public sector. You have Ghana, Tanzania, Cote d'Ivoire, Nigeria. Kian Smith has built one. And then there are others looking to crop up across to take advantage, well, not to take, well, besides just taking advantage, to take the opportunity where gold prices are today and also to try and aggregate across the artisanal value chain, right? Because I think Burkina Faso announced record gold production, record gold exports last year, mostly driven from increases in the small-scale artisanal miners. With respect to the AFCTA, on the infrastructure bits, I mean, you're talking about logistics. Logistics in terms of bringing the the consumables in, logistics in terms of moving the gold, logistics in terms of permitting. So there are a few things we can look at, which is how do you aggregate that in an efficient manner from a cost perspective, from a speed perspective, because I think one of the big issues that we're seeing is once you drop your gold, how quickly do you refine it to the grade that you want or the accepted grade for you to trade? Then that's one. And then two, there's always the issue around the certification. I see LBMA is quite active in this conference, which is a good thing, because it's not a market you can ignore anymore. One of the biggest areas that we're looking at as well for AFC, even though it's probably going to take time to get there, is how do you have an LBMA certified refiner on the continent? And how do you get all the other producers and exporters to move to that refiner? Because of the process and the rigorous process it takes to get a refinery certified, I just can't see a situation where LBMA is certifying 10 of a few of those. So if you could get one of those done, I think it reduces your logistics cost, because right now everyone is moving to either Rand, Dubai, Metallo, etc. And it also increased the turnaround of the cash flows. I think one of the big issues around the small-scale mining is the working capital cycle. In terms of when you prepay for the gold, when you get the gold, when you refine it, get it certified, and then actually when you get the cash, right? That cycle needs to be shrunk significantly. And if you can get a certified refiner on the continent, and then get producers to sign up to, using that refiner, it increases the turnaround time for everyone. So, and it also allows you to be very competitive, right? Because right now, the refiners that are certified are able to offer prepaid terms to big gold producers, which some of the existing ones can't at the moment, because it also opens your financing structure. There are banks out there, the JPs, the Bank of Americas, etc., who wouldn't touch certain refiners on the continent. But the moment you're certified, it does improve all the financing that's available to them. And they can offer the likes of, and hopefully, the intention is one day Kian Smith can offer a prepay to Indaba Mining, as an example. And they get comfortable to actually refine the gold there, which also increases the capacity across the continent. So right now, we really have Rand, which is the big producer. The intention is you have to build others across the continent to continue to take advantage of the sector.
Thank you very much. Over to you, John. I'll speak more to ESG and sustainable finance. Sustainable bond markets are projected to grow significantly by 2050. How can African gold refineries align with international ESG standards to access the growing pool of climate-aligned transition financing?
Crikey, it comes outside my area of expertise, to be honest. I'm more in the exploration space than the mining, so I can't directly answer that question, and probably you could better answer that, I think. Yes.
So on that front, I think it's just developing your project in line with the acceptable standards. So right now, quite a few miners and manufacturing companies, industrials, for AFC, we have our environmental standards, which are typically your IFC performance standards or your Equator principles, etc. For the likes of AFDB, they do also have the AFDB standards. And these are quite transparent, rigorous. It's all on the website you can do. I think one of the issues that we have on the continent is it's seen as an expense and not an opportunity to grow capital, right? Which is why we always advise potential sponsors and clients to actually front load the work on that, because it does take time to get through all the required studies that will meet those standards, right? And you don't want a situation where you think a project is ready to go, and once the external financiers do the due diligence, you find out you're not complying a whole bunch of things, right? And then you end up with an environmental and social action plan that is 20 pages, which is just too much and just doesn't attract financing. So it's always good to front load that work from, getting the right expertise. I mean, there are quite a few consultants and expertise out of South Africa that are used to developing projects to the standards required, right? And they would advise companies as well as refiners exactly what's required to meet some of the standards that opens up the capital markets and financing space for people to attract, very attractive cost of capital. If not, you just basically tie to just your local financing, and to a certain extent, maybe regional financiers who have their own standards. But for the international markets that are looking to back the sector just because of where the commodities are, you have to incorporate that into your program. And you have to have the right expertise externally as well as internally. Because once those action plans and management plans are put together, somebody has to follow through to make sure that refiners are adhering to them. Thank you.
Could I add to that?
Absolutely. Take it over, madam. Yeah.
Thank you. Just from a listed and also just an unlisted debt space, when you speak specifically about the sustainable issuances, we have, on the one side, we have the sustainable issuances, and on the other side, we have the impact investment. And the impact investment is what Franklin is talking to when he speaks about the, particularly the international investment. That's where the big quantum of the money is. So what impact investors are looking for is they are looking for measurability. They invest with intention, but they need to have something measurable. So that's what your frameworks, Franklin spoke to the IFC, ICMA, the International Capital Markets Association, also has issued frameworks and guidelines for sustainable debt. So it needs to be measurable, because your investor wants to know that you said you're going to do X, and an external verification agent is going to make sure that you are complying with that. There are also organizations like FSD, Financial Sector Deepening, which is based out of Nairobi. They're doing a huge amount of work in training the verification agents in different parts of the continent, and also communicating the frameworks for compliance. So like Franklin's saying, you front load it so that you know that when your issuance or when your instrument is ready to go, you've actually ticked all the boxes that need to be ticked in order for you to be able to access that increasing quantum of impact investment which is coming to this continent. And just to give you an example, there's one of the big South African asset managers, and I was speaking to one of their senior investment advisors, and she said to me, they are getting so much more demand for impact products. And she said, on the continent, including South Africa, we just don't have the projects that meet those requirements. So it's not as if there isn't a flow of capital that wants to come. It's that there is not the qualifying projects, there are not there in order for the capital to invest. So it's a nice problem to have. It's better than not having access to any flow. But we need to actually really concentrate on how we tap into that.
Absolutely. Over to you, John. Cost of capital in exploration. We often find that the reason why, in some cases, financing doesn't come in, it's cost of capital. Would you be able to just give us your view when it comes to exploration, given your experiences in all the other parts of the world? How can we increase that funding that's going into exploration on the continent, especially from a gold perspective? Yeah.
Cost of capital is hard to quantify with exploration. And it's the reason why there is no institutional investment in exploration at all. It is driven by retail investors rather than institutional, and they all have their motivations, but their prime motivation is to make multiples on their money. So the cost of capital per se, as I said, is difficult, if not impossible to quantify. So it's more about looking at the teams that you are backing, even rather than the assets, because the timelines for exploration is generally in years. And between the targeting and the initial discovery through to delineation and evaluation is typically 2 to 5 years. So what is the cost of that capital? You need to make the multiples so the cost is not necessarily a calculation that anybody takes into mind. Once you've discovered a resource and you've started to delineate it, you can then start to put metrics around it, and you'll start to get funds and institutions starting to invest in around the delineation stage, because then they can go, if we invest here, this is likely to be the return over the medium life of this asset through evaluation, development, and the commencing of production. And the banks like AFC, they will only get involved at what I call stage 6, which is in the development of an actual project. And then they can quantify what return they're going to get, and the companies can then go, what is the cost of capital for equity versus debt, and they can balance that up there. But that is all in the latter stage of the development of a mineral project. In the earlier stages for exploration, as I said, it's very difficult to quantify.
Follow-up question, since we went past you in the second round. We often hear of AI and exploration. Obviously, we're in the era of AI. Is it a companion to the exploration geologist, or it's actually taking over what the exploration geologist would do? I know it's a contentious question. It's often what we're getting out of, we saw in Zambia, for example, with cobalt metals. It was a big thing, the way it was written. So what's your take on that? Is AA enhancing existing tenements, that perhaps some exploration work was done before and it's now enhancing what was done before, or it's totally replacing the role of an exploration geologist? Yeah.
Thanks. I think Tamsin touched on it a bit to start with. It's actually about data to start with, and it's getting quality data and acquiring that before you can apply AI. So AI is only a tool when you've got the data, and until you've got that, and it's collated in a format that can be analysed by AI, it's not going to help. So if there's data in place, these tools are always helpful. Being able to throw masses of data at a computer and it can intelligently assess it is always a benefit.
Thank you, John. I had to come back to you, obviously, so that you can, beef it up. Madam, so I'm going to ask you a question about bypassing national infrastructure. I think it's a bit of a countries without national central securities depositories could join regional systems directly to lower costs. Would the regional gold CSD be the key to facilitating low-cost cross-border trade in refined gold as a financial asset?
Sure, I feel a bit like John in the second question you asked him. But firstly, John, I just want to say on that, is AI going to replace the exploration geologist? I wanted to hear if there were any completely irate exploration geologists in the audience who were going to say absolutely not, because AI can't lick the rock. That was just there. On the question of the CSD, so in principle, a CSD can be shared and can absolutely be shared to lower costs. It's like a national airline. Every country doesn't need its own airline if it can use somebody else's airline more efficiently. So I would say in principle, yes. But again, I'm going to go back to what I said about the sovereignty issue with regional exchanges. If that kind of system, that kind of shared CSD is going to be set up, it's going to have to be set up very clearly and with very clear, John used the word delineation, about who has rights and who has obligations and what they are. So in principle, I'm all for shared infrastructure, because if I am Lesotho, I don't need to have the same infrastructure as Morocco, but I can piggyback on it, again, particularly in this age of digital tech, etc.
Thank you very much. John, back to exploration. I think, what do you see when it comes to exploration on the continent? I'm saying project for us the trajectory that you see exploration going on the continent, especially in the gold sphere itself.
Exploration will only happen at a core level if we have the risk capital available to spend on it. So the problem we have at the moment with the artisanal mining is there is what we call in Nigeria as a now mentality. We simply don't have the time or capital to expend on exploration, so we are just looking for anything and we start digging it out. And so whilst they're to use the analogy, they can't see the forest for the trees because they're looking for just a tree, when if they stood back and go, actually there's a lot of the trees that we're looking for, which is time and money. So how do I see it going? With risk capital into this system, I see it expanding quite quickly. But it's providing the ecosystem and the infrastructure to do that. Now in Nigeria, we have all of those elements. It's just knitting them together, which we're in the process of doing, to be able to tap into that. But that also takes good teams of people on the ground to do that. And it's bringing our standards up. Our geologists in Nigeria, for example, are used to looking for trees rather than forests, because their payday comes by finding a tree, not a forest of trees. And so it's changing their mindsets to go, actually, no, take 3 or 4 steps back and start looking for the forests. But that only is when you've got capital that is prepared to wait for the bigger discoveries.
Franklin, I'm going to ask you a question on the role of state-owned enterprises. Many of Africa's largest mineral companies are SOEs. How can improving SOE governance framework serve as foundation for their eventual listing on domestic equity markets to raise expansion capital?
Quite an interesting one. I'm not even sure if the SOEs want to list. But if we stick to the mining sector, I think, well, let me just take the general So your largest, I think I've read this before, that the largest South African company is actually Eskom. And then if we then go to, in terms of from a resource perspective, the largest on the continent are NNPC for Nigeria and Sonangol out of Angola. These two institutions are on an annual basis now raising multi-billion-dollar financing programs to finance various capex programs on their oil blocks, offshore, onshore, gas infrastructure, LNG, big, massive projects across the continent. On the mining side, just 48 hours ago, we saw Mali created a state-owned entity, I think Soremi. Guinea has had Sojupami. DRC has Jekami. Cominiere as well for the tin, tantalum, tantalex. Sorry, tin, tantalum, etc. And they also have Jekami for copper, cobalt, etc. And then I can't remember the gold one. But none of this have transitioned the way we would have expected them to transition, right? I think Jekami under the current leadership is trying to get there. They're trying to get to where you would say the Sonangols, the NNPCs are today. To be fair, which I always explain to people, if you take a country like the DRC, technically they've had just 4 democratic elected presidents in their history, or maybe 5 max. It's difficult comparing that to a Nigeria or a South Africa, etc. So the political system is still forming, and you shouldn't expect that they will be at the same pace as an Eskom, an NPC, or Sonangol. You know, these are, Sonangol has been raising financing from Standard Chartered, AFC, Afrex, and for the last 20 years, right? So these are they're named staple in the markets. But they are, in the near term, they are definitely signs that they are turning it around. They've actually entered an agreement with Mercuria in terms of the equity offtake. Once they're able to prove their track record, the financing is going to come in place. Now, whether they transition that to a public listing, to be honest, I can't see that in the near-term horizon. But getting to a situation where you can raise multi-billion, financing programs to support, copper expansion production from 3.3 million tons to 5 million or 6 billion, that's definitely in the horizon, right? And obviously them also being able to, because they have to maintain their equity stakes, right? Right now they're getting free carries, but they will get to a situation where they don't want to get any more free carry, but in addition to the free carry, actually invest equity in their projects to maintain control of the strategic minerals, right, which is dictating geopolitics across the globe. So we're probably going to see that in the DRC. The gold sector, likely that's going to be the case as well, because gold is now becoming, basically whoever owns gold has a seat at the table. Thus, it's important that we understand that it's not going to happen tomorrow, but there are steps to get in there. So everyone is having a financing program. I think Ghana is opening up with gold traders. Mali, we'll see what happens there. Sojupami, we can see what has happened with the Simandu project, with CTG and the government of Guinea. Thus, I think over the next 5 years, don't be surprised to see a couple of multi-financing programs to back some of the equity investments. Thank you.
Thank you, Franklin. In 20 seconds each, can you please give a parting shot? Then we'll conclude. In 20 seconds.
Would you like me to start?
Yes, madam.
Okay, I'm going to speak very quickly.
Yeah.
All right. So what we need to do as a continent is we need to find a way to work together so that the second scramble for Africa benefits us and our children. Okay, that's the first thing. But in order to do that, we need to make use of frameworks that we do already have and those are frameworks under the African Union. In terms of, Franklin mentioned the Continental Free Trade Agreement, but the African Minerals Council, the African Mining Vision, they are already encouraging us to work together and to collaborate. But I think what we need, particularly from the AMC, is actually some more formalization of how we do the financing on a cross-border basis. From a producer level, that's absolutely one option. Gold producers work together. We also need to, as I said just now, get the ecosystem in place. And that means that the AFCs, the AFDEBs, the AfrExim banks, and the DBSAs, all of those parties work together to ensure that the guaranteeing is in place, that the correct structuring is in place, that the hedging is in place, and that we benefit as Africans at the end of the day.
Unfortunately, our time is up. John, I think she also spoke 2 seconds.
If we want mining in this continent, you've got to go with exploration. If you want exploration, you need risk capital. And if you want risk capital, it's got to be listed.
Franklin, 2 seconds.
Since I came late,
Yeah.
I'll make it snappy. But on the exploration part, AFC is devising a program to definitely start getting into exploration projects. Hopefully, before the end of the year, something will be formalized. That's one. Two, we are in an era where it's, I'm not sure I've seen this sort of financing in the last 10 years in the gold sector. You're having DFIs now step up into the gold, for greenfield gold projects. I think sponsors need to take advantage of that. There's a lot of interest in the refining space. There's a lot of interest in, having to protect our currencies because we have too much commodity swings, which continue to affect the daily lives of our people. So it's important that we all work together to have a joint framework that protects us and continues to attract capital for strategic projects in the region. Thank you.
Thank you to my esteemed panelists, and really appreciate your time.